Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio, and on the show today we are going to be discussing everything that you have written to us about, a lot of queries that we got from you on our social media channels and on our email ID as well. So keep writing to us and we'll get them answered from our experts. And the expert on the show today is Prableen Bajpai, the founder at Finfix Research and Analytics, and she'll be answering all your mutual fund queries. Prableen, welcome to the show, and trust me, we've gotten so much of them, so many of them, that we are going to be answering few of them today on the show. So thanks a lot for joining in today.
Thanks, Sonal. And I think it's always great to see the interest in the mutual funds and the industry as a whole.
Oh, absolutely. So let's get started then. The first query is coming in from Rishi Bhora, who's writing to us from Mumbai. He says he has 15,000 to 20,000 to invest every month in SIPs to save for child's future. He wants to know which funds are best suited for good returns for, say, a 5 to 7 years time horizon. Probably it's a very specific query, and the sum also is mentioned by our viewers. What do you suggest should be done here?
So honestly, Sonal, it should be done the other way around, in the sense that, he should have a figure in mind that he's looking to build for his child's education. But since none of that is mentioned, I can first give him a figure that with a 20,000 SIP for the next 5 years at 12% XIRR, which is, I think, a very realistic estimate, he can generate about 16.5 lakhs, which is pre-tax. And if it extends to 7 years, then a corpus of about 26.5 lakhs can be generated, again at the 12% XIRR. And for the funds that Rishi can choose for his child, probably 3 to 4 funds at maximum, so 5,000 each, let's say. So I think it can be 2 passive funds and 2 active funds. So starting with a large cap passive fund and a mid cap passive fund, add a flexi cap to it. Flexi cap because it would have most of the flexi caps have a large cap tilt. So it would sort of fill in the gaps which are there in passive investing. And if the horizon is 5 years, then definitely a hybrid fund can be added. Otherwise, I think it's okay to just skip the hybrid and go with the 3 funds that I've mentioned: a large cap, mid cap, and a flexi cap.
Okay, all right. So that is how one can save for the child's education or the future, that the plan is here. Let's go across to the next one, which is coming in from Atul Krishna, writing to us from New Delhi. He says he has been holding debt mutual funds since last 10 to 15 years and wants to know whether indexation can be applied on sale of his funds before 31st March 2025. Prableen, this is a question we've been getting from a lot of investors, because there have been so many changes. I don't know if it got simplified or it got more complex after the changes that we saw in the recent budget. What do you suggest? What can be done by Atul here? And what would the implication in terms of taxation be, most importantly?
You're absolutely right, Sonal. Too many changes in the debt mutual fund space in terms of taxation. So last year they were, brought into the tax slab totally. And before that, we were able to avail indexation. And now, again, that continues. And now the differentiation of when you redeem, that is also there. But since Atul is asking this query now, so it's post-budget. So whenever he redeems now, because it's like a 10 to 15 years holding period, all his gains are going to get taxed at 12.5% flat. So he cannot avail indexation. That is only for those investors, and it's, for your viewers, let's say, who redeemed between April and July of this year, they can avail the indexation if they had a holding period of 3 years and above. So for him, it would be a 12.5% taxation. Now, whether this would be will work in his favor or will increase his tax liability will depend on the returns that he's generated. So let's say his returns have been in line with the cost inflation index at around 6 to 7%, then he would be at a disadvantage redeeming now because the tax liability will definitely be higher without indexation. But let's say if he has made about 11 to 12% returns, which is rare in debt funds, but let's say if he had those kind of offerings where he's made those returns, then he may be better off with this 12.5% taxation now. So it'll depend. And going forward, I think debt funds, any new investments, because they'll all be taxable at slab now. So probably he can consider hybrid funds. I think that can be a good choice, which would bring him from the fixed income sort of to a hybrid product with his risk going up in the overall portfolio. But I think that would bring in some growth as well as, lower his overall tax liability.
Okay, all right. So that explains how you would go about it, the viewer that is, in terms of the taxation that would be applicable in case you redeem after 31st March 2025. But as Prableen mentioned, there are a lot of time frames to be considered if there are other tax rates that would be applicable on your particular transaction when it comes to debt mutual funds. Let's move on. Nimartha Kaur writes to us from Punjab. She says that she's planning to begin her mutual fund journey and wants to invest 8,000 per month. She wants to know which fund should she start her SIP in. And I remember her mentioning as well that maybe it's a question that comes often. So she's sorry for that repetition, but she still wants to understand how can she go about it. Prableen, what's your take here? I know it would depend on the risk and other profiles as well, but just as a starter pack, what should she do?
Assuming, Sonal, that she's looking at the long term, so we'll go with that. Then I think with the 8,000 allocation, 2 to 3 mutual funds are good enough. And that's just to create a structure for her so that whenever she's looking to increase her investments, she can first increase within those 3 schemes, let's say. So again, it would be, if it's a long-term portfolio, it would be a large cap passive fund, a mid-cap passive fund. Large cap can be the Nifty equal weight, and a flexi cap. If her risk appetite is slightly higher, though she is just beginning, then instead of a flexi cap, she can probably look at a multi cap because that would give her some allocation to, in fact, a minimum 25% allocation to small caps. So that's how she can construct. And I think going forward, when she's looking to increase her SIP, first she should increase in these 3 categories, and then probably add a small cap or any other category depending on her goals. With a 8,000 SIP at 12% XIRR in 15 years, because that's the long term I'm taking for her, she can create about 40 lakhs Sonal. But if she's doing a, let's say, a 10% step up, so every year she increases her SIP by 10%, then with the same investments, with a 10% step up, almost 70 lakhs can be created. So she should definitely start off with these 3, and I think incrementally, make those investments each year. I think that is very crucial.
Right, that's very helpful, Prableen, and it'll definitely start her investment journey with a lot of expert advice coming in there. Let's move on to the next one. Prashant Srivastav writes to us from Noida, wants to know whether it is still a good time to invest in Parag Parikh Flexi Cap Fund, and also asks if it is the only way to take exposure to international stocks. Interestingly, Prableen, recently we had a chat with the CEO of PPFAS Mutual Fund, and he indicated how they are a little cautious on the markets right now. So maybe there could be a short-term pain here. But over a long term, how do you look at this fund? What has the performance been like? And also the exposure to international funds?
Well, PPFAS, FlexiCap, I think it's been the darling of everyone. It's one of the best performers in the FlexiCap space. Definitely beaten the category average benchmark on rolling return basis. So the performance has been great. It has had its own periods of where the performance wasn't that good. For example, when international markets in 2022 didn't do that well, there was a hit in the fund as well. Like you said that, somebody from the fund house was there and they are cautious. So that is quite evident in the cash holding that they have actually, Sonal. So they're holding about 10-11% of cash currently. But their international investment exposure, which can go up to 35% because of the RBI restrictions and the inability to add more funds, has actually now fallen down to about 12%. So of the overall AUM, currently 12% is outside India. So if you're looking at international investing, and this is the reason why, Prashant is looking to invest in PPF, I think that's the wrong reason. It's a great fund to add as a flexi cap. But if you're looking to take exposure outside India, now even the regular international mutual funds will be at 12.5% taxation. And so will be all the equity mutual funds in India. So I think that consideration is sort of, it's null and void. So you can look at a pure international exposure. Again, very limited options available there. But you can look at the S&P 500, you can look at NASDAQ 100, a couple of options still available from Motilal, which are open. ICICI closed very recently. So, Sonal, this pain is going to be there, about how and where to allocate abroad till the time the RBI doesn't sort of increase that limit of investing outside India. And I think that is a very long-standing demand from the industry as well.
Oh, it has been for sure. Okay, all right. Those are a lot of queries and very helpful answers as well, Prableen. But we have to take a quick break. On the other side, we'll come back with more MF queries that have been sent to us by our viewers. Stay tuned. Welcome back. You're still tuned into MF Corner. We still have with us Prableen Bajpai, the founder at Finfix Research and Analytics. And we are here answering all your mutual fund queries that you have sent to us. Prableen, let's start with the next one. Partha is writing to us from Mumbai. He asked the best mutual funds for investing in kids' education for a time period of 15 plus years. A lot of these queries coming in for kids' education. Again, it's a little vague in terms of the amount that would be invested in everything. But what's your suggestion here, Prableen?
With the 15-year horizon, firstly, Sonal, it is so important to look at the education inflation, which is going to impact his goal. For example, today, let's say he takes a goal of about 40 lakhs for his child's education. So in next 15 years, education inflation in India is estimated at around 10 to 12%. Even if we take 10% inflation, the same 40 lakh requirement will turn into about 1.6 crore requirement. So it's very important that, he sets that goal right today so that he can invest accordingly. And the funds, of course, I think that is the next part, while that what funds should you be selecting, but it should be equity mutual funds. And again, a combination of active and passive funds. I think, you start off with a passive large cap, you mix it with a mid cap passive fund, and definitely you can add a flexi cap to it. And because it's a long time horizon, it's a 15-year period, I think a small cap can be added to. For this specific example that I gave, an SIP of about 30 to 33,000 per month will be required at about 12% XIR returns. So, Sonal, it's so crucial that when we are planning for a child's education, number one, we really need to invest in a product where we are able to beat inflation. Because if we are going to invest in a product, let's say PPF, and we think let's invest in PPF and invest for the next 15 years, you're going to earn about 7.1% returns, but the inflation is way higher. So your money cannot grow and match up to the requirements at that point in time. So equity mutual funds, definitely, I think, for the exposure and the right amount to be invested. And I think with these four categories, but you have to stay disciplined, stay invested, especially during downturns. That is really, really crucial again for generating that sort of a corpus.
Okay, all right. So that's about education inflation. We can talk about the way it has been surging off late, right? But move on to the next one. Harshit Saxena writes to us from MP. He asks how long should one continue with small cap funds, and also wants to know whether correction in small caps can be expected soon. It's a question coming in from a lot of viewers, Prableen. We've seen ebbing of flows a little bit, not so much. But what's the general sense?
So, for example, Sonal, 18, 19 weren't that great. Then 2021 were good. 2022 was mediocre for the small caps. 23, 24 has been good so far. So, that cycle will always continue. Small caps, there's so much of this chatter about the valuations and everything. So, of course, everybody is expecting a correction there. But whether he should continue or not will depend on his goal. Let's say that his goal is away, and he's doing an SIP, then even if there is a correction, I think it's okay. If you have the stomach for that kind of a risk appetite and you're holding small caps, I'm sure he can be okay to go through a downturn. And so you continue. But let's say your goal is 2 years away or 1 year away, then definitely you should book profits, or you only invested with the idea of making some money. Then also, I think definitely partial profit booking should be done at this stage if you've made decent money. But if it's a long-term portfolio and you're comfortable with the allocation percentage in the overall portfolio, then definitely it can be continued, especially if it's staggered through SIPs.
Okay, so that's Prableen's idea on the small cap space. If you're in here for the long haul, it would be different as well. But Sangam Singh is writing to us from New Delhi. He wants to know how to invest and get exposure in US mutual funds. Prableen, how can one go about it?
So there are a couple of ways, Sonal, how can we invest abroad? And I think, of course, the interest in investing abroad has spectacularly gone up in the last 3 to 4 years. I think post-COVID, we've seen this massive interest rise. So one way is through the mutual fund industry in India, that you invest in a mutual fund in India, which is investing in an index fund, tracking an index abroad, or is investing in some other mutual funds abroad. There are actively managed funds available as well as passively managed funds available. But again, that universe, the choice is very restricted currently because of the RBI's limits on the overseas investing by the industry. Second option can be that you go through one of these online platforms which are there, which are basically technology platforms, and they collaborate with a broker abroad, for example, in the US. And through these platforms, you open an account outside India and then invest. One of the examples would be Vested. There are a lot of these platforms which are available. So you can invest in direct stocks or you can invest in mutual funds abroad. And the third way is to directly, let's say, go to a broker abroad. For example, you in the US markets, you would have Fidelity, you would have interactive brokers. So many of them allow direct, account opening by, for example, as an Indian resident, I can open an account with them and trade and buy stocks as well as mutual funds. And the second two options, through a technology platform or through direct opening of a brokerage account, so both of them come under LRS. But the investments through mutual funds are not under LRS, but the other two will, and all of them will have the same taxation, the 12.5% taxation after holding period of 2 years.
Okay, all right. Take that point. That's very helpful, Prableen. Moving on to the next one. Karthik Goel writes to us from Noida. He asked whether one should invest in mutual funds via brokers or directly in mutual fund houses. That's been an ongoing debate. What's your take here, Prableen?
It's very difficult one, Sonal, whether you want somebody to manage your money or not. So broadly, let's first look at the options available. So number one, that I just go to an AMC website and I open an account and invest in direct plans of the fund house. Second is that I go to an online platform which is giving me the choice to invest into different fund houses. So that's of course preferable. But many of these platforms charge you a basic fee, let's say 200, 300 rupee a month, that kind of a flat fee, and then you can just invest in direct plans from there. The third way is that you pay a fee to an advisor, let him do your financial planning, and then let him plan or her plan your portfolio, and then you invest in direct plans. And the fourth way is that you choose a reputed distributor and let him or her do the planning for you and guide you with a portfolio, and you invest in regular plans. So there are multiple ways. Now, which option should one choose will really depend on your own preference, your own knowledge level, how much you understand, what is the corpus like. I don't think somebody with a very, very big corpus is operating on their own, because, they would want probably an advisor or somebody to help them with all the operations related work, which is there, related to your investments. You would want things to be more streamlined, somebody in picture who can guide, during the investment process. So I think the decision making has to be very, very, it's a personal choice. But I would say if you're starting off new, there is no harm in taking guidance and doing it the right way.
Okay, all right. That's important, of course, when you're starting new. Nothing wrong in taking some help coming in from experts. Moving on to the next one, Gaurav Mantri writes to us from Indore. He says that since fund houses are sitting on a lot of cash, is there a situation of panic coming in the future? That's the first sign of maybe that there's some caution, but is it a big trigger or a big sign of something leading to a big fall, Prableen?
It's interesting. Gaurav's question is very interesting, Sonal. Some of the fund houses do have a decent cash holding, for example, somewhere between 8 to 10, 12%. But that's a few of them only. So if you look at the mid caps, there would be about 4 to 6 fund houses which have a 5% going till about 14, 15% of cash holding. But that's very limited out of the, let's say, 29, 30 mid-cap funds which are there. Within the flexi-cap space also, I think there are only about 3 fund houses currently which have a cash holding of about 10 to 11%. And the majority of them have the usual, 2 to 4% kind of cash holdings. So I'll say that this assumption that everybody is holding a lot of cash is incorrect, because a lot of fund houses believe in being invested. So philosophy-wise, fund houses, they vary. Their investment processes are different. Some of the fund houses are more cautious, where maybe they're looking for an opportunity. For example, Motilal has been very active with taking, cash calls. We are seeing UTI also, they're holding decent cash. We discussed PPFAS, FlexiCap, they're holding decent cash. So I think, Sonal, that is more to do with the definitely philosophy that the fund house has and what is their view on the markets. So if they're more into value investing, probably yes, they would be holding cash. So I think it's dependent on the outlook. But and when the correction in the markets, I think it's so hard to predict. So I don't think the fund houses are doing that. I think it's their, it's a part of their own investment process. But yes, as everybody is talking, we do expect that the markets either, they can be probably sideways, or there will be a reaction. Let's say if something globally doesn't work out well, be it the US recession, election results, there are a lot of triggers, Middle East crisis, but hard to say, when and how much, by how much will it happen.
Okay, all right, Prableen, we do have so many queries left, but we are completely out of time on the show today. But thank you so much for joining us today and giving us your perspective on different aspects. And we covered a lot of it, from debt taxation to flexi-cap funds to multi-asset funds to education inflation eating into savings as well. So thanks a lot for joining in today, and hope to be speaking to you very soon again.
My pleasure. Thank you, Sonal.
Okay, all right. That's all we have on the show today, but stay tuned for Closing Bell to take you through the last hour of trade.